The QYLD Dividend ETF is a monthly paying dividend ETF that has the highest yield of any dividend ETF that I know of. Right now, it's paying about a 15% yield and it pays you every single month. So I'm going to tell you exactly how you can make $8,300 a month just investing in QYLD. That's $100,000 a year. And then you can have the passive income that everybody dreams about while the little stock gremlins are out making their dividends for you and you get your dividend in your pocket every single month. All right, this all probably sounds too good to be true. This is an SEC regulated fund, right? It's not one of those funny money cryptocurrencies that's a scam and it's going to have an FTX Sam Bankman-Fried fraud in the next 3 months. But there are some catches and there are some things you need to think about and there's some risks associated with it and there might be some better options for you to invest in other than QYLD. So I'm gonna give you the full picture in the next 5 minutes and let you make your own decision. Again, I don't make any recommendations here. I am just providing you entertainment and information. First thing to know, and this is where this story starts to crack, right? The first thing to know is that its trailing 12-month yield is 16.39%. But more importantly, for somebody buying now, the distribution yield is actually 12%. That is the annual yield an investor would receive if the most recent fund distribution remained the same going forward. Okay, so the trailing 12-month yield, the 15% yield, right? That calculates everything that has been paid out through the last year. So it would count from November 2021, you see a 22-cent dividend that month, then a 50-cent dividend, then 20, then 20, then 21, 21, 18, 17, 18, 18, 17, and 16. So the forward yield is based off of if this last one, the 16-cent one, is the one that got paid every month for the next year at today's net asset value, that's where you would have that 10% yield. Now, here's the thing. This dividend isn't always super reliable. You can see they always pay the dividend, yes, but the dividend actually has not grown over time, or at least not substantially, right? So in 2014, it paid a $2.57 dividend, then $2.20, then $2 in 2016. This is going the wrong way. It's going down. $1.80 in 2017. Then a huge jump to $2.65, $2.30, $2.54, and finally $2.85. But again, now it's on pace to actually be below 2021 if they were to stick to their last paid dividend in the last month, right? So what the heck is going on and why is this happening? It's because the QYLD generates income through covered call writing, which historically produces higher yields in periods of volatility. So when there's a lot of volatility, call prices, the premiums on them are higher, meaning when you sell them, you collect more premium. The premium from these calls is how QYLD pays its dividend. It does not pay its dividend through distributions of dividends paid by the stocks it owns. So you can see it owns Apple, Microsoft, Amazon, Alphabet, Tesla, Nvidia, Pepsi, Meta, Costco, and others. Some of these, yes, they do pay dividends, but for the most part, the dividends are not that high in these stocks, certainly not anywhere near the 10 or 15%. It writes monthly at the money index calls on 100% of the fund's portfolio to generate that income. You can see call positions, it sells at the money covered calls on 100% of the assets, meaning 100% of the upside of this portfolio, of this fund, is forfeited. What does that mean? So you can see through the history of this fund since 2013, the share price of the fund is actually down 34%. That looks terrible, right? But because it pays a dividend, you still have a positive return. But that's just to show you the price of the fund is not going to go up because it doesn't get any appreciation of the shares underneath and then it has to pay the dividends out, right? Really, since 2013, the total return, which includes the dividends and the share price going up or down, is plus 65%. See here, the S&P 500, if you simply own that, is actually up 246%. QYLD may not be a great investment for people that are building a portfolio and not looking for that income. How should you actually use this thing? Well, they tell you right here in the strategy. It can be a replacement or complement to equity and fixed income exposures for investors who are seeking strictly high income with reduced equity volatility. But that's not the best way to build wealth over time. Total return is the best way to build wealth over time if you don't need the money right now, which I don't, and most people in their accumulation phase where they're still working before retirement don't need the dividend income. What does all of this mean? In my opinion, for somebody like me, I am not interested in owning QYLD right now because I don't need the income to live off of, and it would actually damage my long-term opportunity to grow a portfolio. What I want to do is I want to invest in something. If I was going to own this, I would much rather just own QQQ during these years of my life, and here's exactly why. This fund essentially buys the stocks that track the QQQ, right? So you get all of the downside with that, but you don't get any of the upside. And here's how the QQQ has done compared to QYLD, and this is total return, so it includes dividends, and this is since 2013. The QQQ is up 258%, and QYLD is up 66%. So what would a better strategy look like, and what is this $8,300 a month I'm talking about in dividend income? If you start with a $0 investment, invest $500 a month for 30 years at an 8% return, which is actually a little bit below the 10 and 15-year average of the QQQ. This is what you would have after 30 years. At 6%, you would have $474,000. At 8%, you would add $679,000. And at 10%, you'd have $986,000. If the QYLD dividend yield was 15% and we had that $700,000 after 30 years. So say we start at 22, invest till we're 52, earn somewhere between 6 and 10% a year, and we have $700,000. If there's QYLD paying a 15% dividend, then you're making $105,000 a year. Divide that by 12, you're making actually $8,750 a month. My plan would be to invest in individual stocks or my favorite ETF during my accumulation years while I'm still working. Then once I hit retirement, I'm gonna look for a very high dividend paying ETF that's really stable at the time. It'll be a long time from now that pays a 10 or 15% dividend yield, and then I'm going to take that income over time. If you want to know why I think SCHD is actually the best dividend paying ETF of all time, watch this video right here.